Hello friends. Last week in my video, I took up the matter of whether the markets were going to hit new highs. I also contemplated the reasons that were holding the bulls back from making big ticket commitments. In this week's video, I want to tackle the issue of what is holding the bulls back. So let's dive right in. According to me, what's holding the bulls back is the international nervousness about interest rates, which Bank of England has hiked by 0.5%. So rate hikes are not done and over yet. This is something that I have very clearly covered in my Telegram channel time and again, saying that rate hikes are not yet done. There will be a few sporadic rate hikes. The overseas markets have provided nervous triggers, but the main important reason that's holding the bulls back is the peaks that were made on the Nifty and Bank Nifty in December 2022. Those were previous swing highs. As and when the indices are approaching the December highs, there is a phenomena in technical analysis known as overhead supply. Traders who are trapped at previous swing highs wait for their prices to come back before they start unwinding or offloading or squaring up and closing their long positions. Now, this supply has to be completely absorbed by the bulls. Stronger hands need to absorb whatever the weaker hands are selling, and only after this process is complete will new highs come in. So now you know the reasons that are holding the bulls back. Now, do bulls have the firepower? Do they have the willpower? Do they have the money power to take the markets higher? That the statistics will tell us. And let's take the statistical outlook on the market, which we are so known for. Coming up on your screen is the market roundup window, which tells you that both the Bank Nifty and the Nifty 50 fell. The US dollar index, the DXY, went up by 57 basis points. Now, whenever the dollar index goes up, it has a negative impact on commodity prices. So gold and silver fell. Silver fell disproportionately because it had risen disproportionately earlier. Crude oil fell, whereas natural gas rose. It is not actually a rise. This is nothing but the 8 rupees cost of carry or rollover cost that is paid by the bulls to take their long positions from one settlement to the next. So in real effective terms, even natural gas would have come down. On my Telegram channel, I've time and again debunked the super cycle theory in commodities. Please make an effort to join our free channel. The USD INR also rose 4 basis points, which means the rupee weakened marginally against the dollar. The 10-year benchmark bond yields went up by 4 basis points, and slowly but surely the benchmark bond yields are inching higher. But it's not yet time to start laddering. The NSE market capitalization fell by 1.14%, which tells me that the selling was fairly broad-based. MWPL or market-wide position limits went up 1.51%, and all international indices, that is the Dow, Nasdaq, and S&P 500 fell together. That provided headwinds for our market. Coming to our in-house indicators, I take you to the MWPL or the market-wide position limits. This is the extent of limits utilized by traders as against the total permitted limits allowed by SEBI. The higher is the limit utilization, the higher is the risk appetite from two Marshmallow traders. The Marshmallow theory is explained in a separate video, links to which are in the description below this video as well as in a pinned comment. So the MWPL is at its highest in 20 weeks that are covered by this chart. So big ticket bulls, smart money is definitely writing out bigger checks, and the retail traders are taking contrarian positions. Very simply, it means that volatility or statistical beta will rise because one of the two parties has to blink. That is the rule of the market. One party has to lose money and the other party will make all the profits. So the market will make outsized moves, very large moves in whichever direction the winning party is placed. So if the bulls win, there will be large upswings. If the bears win, there will be large downswings. Now, that is the nature of high MWPL. So volatility is likely to be high. Let's be careful out there. The second chart is the stock and index futures turnover. Now, the index and stock futures turnover is of three concurrent series, which is June, July, and August. And both indices and individual stock futures turnover has gone up, which means one Marshmallow traders have participated well in the selling. That tells you that traders are willing to short the market as long as money can be made. I now come to the advanced decline ratio. This is the average of the entire week and it covers 20 weeks for perspective. Now, the Nifty gain loss line tells you that the index has lost 0.85% and the advanced decline ratio also fell below 1. Now, the fact that it is at 0.74 tells you that for every 100 losing stocks, there was only 74 winning stocks. So the one Marshmallow traders or the intraday traders lack the conviction to buy large enough lots to keep the ratio higher. Now, unless this ratio stays above 1 with rising prices, I think the markets will continue to remain under pressure. So please monitor this ratio in real time. Also remember, this week is an expiry week, so volatility as it is likely to be higher. Coming now to the basis. The basis is nothing but the discount or premium enjoyed by futures over spot. What you are seeing is the Nifty and the Bank Nifty basis has come down fairly sharply. As a matter of fact, basis has halved. It has come down by 50%. Now, one of the reasons why basis comes down is as the expiry approaches, the futures prices tend to converge with cash. But selling and buying also makes a difference. The fact that basis has come down tells you that the bulls are willing to pay a lower premium to go long in the market. So there was a certain amount of nervousness. This nervousness has to go before markets can breach the glass ceiling of a new high. I now come to our in-house exclusive indicator, the impetus, which you have been enjoying and trusting for the last 2 years. The impetus for both the indices has fallen marginally, which means the indices have fallen and the force with which they have fallen has come down slightly. That is good news, or rather, in a way, a saving grace for the market, that the bulls were not really pressing sales too hard. Remember, I was telling you in the some few minutes ago that this is overhead supply coming in from a previous swing high. We'll see more of this in the Nifty and Bank Nifty segments. Now, for another in-house indicator, the lift weight thrust drag index, which is exclusively our own in-house finding. You won't get it anywhere else on the internet. You've tried and tested it on a day-to-day basis on our social media accounts and seen how accurate this really is. Now, the Nifty gain loss line, the blue one, tells you that the index fell 0.85% and the LWTD index kept below zero for the second consecutive week. Very simply put, this tells you that this situation is termed as drag. Don't get confused intimidated about this index. That tutorial video is in the description and in the pinned comment below. You will understand what the LWTD signals are and how to interpret them and use them in your day-to-day trading. So in the coming week, I expect weaker fresh buying support on declines. Do remember it's an expiry week as well. Friends, our in-house indicators done. I now come to the bond market. Do remember, we have been taking the lead in covering bond markets because we feel this market fuels all the other asset classes, and the bond yields have gone up as we discussed in the market roundup window. This basically tells you that bond prices fell, which is why the yields went up. Now, there's a mark-to-market loss on bond portfolios of banks, which are the biggest investors in bonds, which is one of the reasons why the bank nifty fell in the week gone by. Now, the bond yields are currently very interestingly poised at 7.10%, which is the trend line support out there. Should they go above 7.10 and start climbing, I think bond prices can see increasing amount of pressure on them. Multiple reasons here. Number one, a weakening rupee. Number two, the overseas markets, and the fact that people are now realizing that there are some countries which are still raising interest rates, and therefore rate hikes may not be done. Am I laddering? No, not yet. I'm not yet laddering in the sovereign investments segment. And I told you, and I rather promised you, that I would share the names of gilt funds whenever it's time to start getting into gilts. I don't think it's time yet, as I have been communicating with my online family on our Telegram channel. That is where we put most amount of our thought process, our research, and trading ideas. That it's not yet time to get into gilt funds, and I'm still waiting and sitting on my checkbook. So, friends, the bond market's done. I now come to the bank nifty, which fell 0.72%. It fell on 3 out of 5 trading days, and the price is now trading below its month-long moving average, which tells you that the average buy and hold bull is under pressure because he's facing a mark-to-market payout. Do note the dashed trend line that marks the 44,152 level, which is the high made in December. This is the previous swing high where overhead supply is coming in. This area has to be overcome on the upside with great degree of force, high volumes, and rising open interest, so that all the sellers that they have to sell, that stock can be absorbed and bulls can take the bank nifty into blue skies territory. Till that happens, the markets will remain somewhat cautious. Let's now turn to the weekly chart. Friends, here again, you can very clearly see the 44,152 level acting as a hurdle. The bank nifty has never closed above it. Now, in the week prior to last, there was a hammer, a bearish hammer, and prior to that, there was a bullish inverted hammer. I warned you in my last week's video that hammers appearing near a top aren't exactly very good signs. These are signs of volatility, signs of nervousness. And sure enough, last week you were seeing that the bank nifty logged a prominent bearish candle. So that tells you that unless the overhead supply selling is absorbed above 44,152, bulls, everybody is rather, not just any common bull, everybody is waiting for the next guy to buy and push the market higher before they can jump in. Now, if everybody is waiting for the next guy to buy, the next new high does not come. So we want more proactive buying to come in. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook is still positive. In the week before last, this index was number 7 on our statistical beta list that we maintain in-house. Last week also, it remained at number 7. So volatility remained unchanged. Last week, I advocated a range between 45,100 on the upside and 42,775 on the downside, which held perfectly well. In the coming week, I anticipate a range between 44,750 on the upside and 42,500 on the downside. I think we should play a very cautious hand, trade on low volumes. Friends, the bank nifty done. I now come to the Nifty 50, which fell 0.85%. And like the bank nifty before it, it also fell on 3 out of 5 trading sessions last week. The price still remains above its month-long moving average, which tells you that the short-term outlook remains positive for now. Do note how the December 2022 swing high at 18,887 is acting like a hurdle. This is something that I told you about in the overhead supply theory. Unless the previous swing high is taken out with extreme force, there will always be residual selling coming in from people who are trapped at the previous swing high. We need to buy everything these guys want to sell before the markets can go higher. Coming to the weekly chart on your screen, you can see that the previous week's bullish candle has been pierced by a bearish candle. It's pierced more than halfway through, which basically is an indication of weakness. Follow-up action will decide what happens next. If the bullish candle's low is breached on the downside, more falls can occur. And if the red candle's high at 18,887 in the spot segment is overcome forcefully, you could basically see a new high coming. Now, we need to watch where the prices are going rather than try to second guess the market. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also optimistic for now. In the week before last, this index was number 5 on the most volatile list as per statistical beta that we maintain in-house. Last week, it rose 2 notches to number 23. So volatility has gone up a tad. Last week, I advocated an estimated range between 19,225 on the upside and 18,425 on the downside, which held perfectly well. In the coming week, I estimate a range between 19,050 on the upside and 18,275 on the downside. Friends, I now come to the retail risk appetite, which I measure by their footprint in the digital sands of the market by the turnover that they contribute in which segment. If they are trading more and more in the riskier segment of the market, risk appetite is high. If they are trading more and more in the safer aspect of the market, risk appetite is lower. So the index futures turnover, which is shown by a blue line, went down by 1 basis point, and the stock futures turnover, which is shown by a red color line, has gone up by 3 basis points. Now, stock futures are the most volatile and take the most amount of span margin to trade. So risk appetite was definitely there. It's just that the prices have started falling. Now, index options, which contribute the lion's share of the F&O turnover, saw their contribution go down marginally by 3 basis points to be precise, and stock options turnover, which is indicated by the purple line, also saw its turnover contribution fall by 3 basis points. So the only gainer in the contribution turnover was stock futures, that too just by 3 basis points. So turnover, the risk appetite has gone up marginally, very marginally, but it's still there. There's still hope yet. We'll let the price tell us where it wants to go. Friends, I now come to the segment where I share my trading thoughts, my trading strategies for the week ahead. Like I have been sharing my thoughts on my Telegram channel, which is a free channel. You can please feel free to join. I will continue to seek trading opportunities in interest rate sensitives, which I have been telling you since October last year are the most vulnerable chartically. I will particularly focus on public sector banks and NBFCs to a certain degree. I also feel metal stocks, especially mining companies that dig the metal out of the earth and sell it as a finished product, may remain under pressure. What with all the metal prices continuing to trade weak on commodity exchanges. On Friday morning, I have put out a special advisory on metals and metal stocks for stock and commodity traders on my free Telegram channel. Please take a look at that as well. Now, my hypothesis about there being no super cycle in oil and gas has proved correct again, as oil prices came under pressure. Now, I will continue to seek short selling opportunities in the futures segment in oil and gas as well as theta decay openings, especially since the natural gas options are now coming due for expiry in the June series. I haven't started investing in gilt funds yet, like I mentioned, as in when I do, I promise to update this on our Telegram channel. So my trading strategy for the week is very simple: public sector banks, metals, NBFCs, and seeking short opportunities in oil and gas and metals, as well as metal stocks, especially miners, producers, remaining under pressure. Friends, now for the most popular segment of this video, wherein I share list of 5 stocks that have gained the most amount of impetus on Friday, where you take a small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. This is for scalpers. So different kind of traders, different kind of strategies, which will cover both segments of the market. Remember, this list is valid only for Monday. If you want to be updated about this list Tuesday through Friday, do join our free Telegram channel, where it's the only place where I put up this list. So impetus gainers for the day for Monday are PEL, Sriram Finance, SBI Cards, Ambuja Cement, and Exide Industries. Impetus losers are IEX, NTPC, SRF, Hindustan Petroleum, and Sun Pharma. Friends, before I sign off from this video, I want to remind you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And I'd love to hear from you in the comment segment as to how my work is adding value to your journey as a profitable trader in the market. And please help us to reach out to fellow like-minded smart traders like yourselves by sharing my video with your family and friends and social media accounts. Thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Bye-bye.